Next up, we have a panel, Optimizing Yield, Advanced Strategies and Risk Management for Stablecoins and DeFi. And here we have Romain, the co-founder of Paladin, Brad, the head of Venus Labs, Amadeo of YieldNest, Paul, the CEO of Morpho, and Ajey of Token Dynamics. Let's give them a round of applause.
Hello? Cool. Hi, folks. Good afternoon, and welcome to our fourth panel of the day today. We're going to spend the next 45 minutes diving into advanced yield strategies and risk management for stablecoins and DeFi. We have an exciting panel lined up this afternoon for all of you, and I'm really looking forward to diving into some of the emerging trends and innovation that's been happening in the space in the recent past. But first, let's start off with a round of introductions. My name's Ajey, and I'm a token economist at Token Dynamics. Token Dynamics is a Web3 design firm specialized in developing censorship-resistant protocols and advising on economic security issues. We'll go from left to right. Fig, do you want to go next?
Sure. I'm Fig, one of the co-founders of Paladin. We help projects grow their liquidity on-chain. I also sit on the liquidity committee at Ajey, and I'm an advisor at Usual. Basically, 90% of our business today is helping stablecoins scale in terms of liquidity to be able to provide sufficient liquidity for them to thrive.
Hey, I'm Paul. I'm co-founder and CEO of Morpho Labs. We built the Morpho protocol, was a permissionless and decentralized lending and borrowing infrastructure for anyone to build like the lending and borrowing use case. We launched a year ago, and today we have $2 billion deposited in the protocol.
Hi, I'm Amadeo, the co-founder of YieldNest, a liquid restaking protocol that offers maximum risk-adjusted returns on your base assets.
Hi, everybody. My name is Brad Harrison. I work on Venus Protocol. I head up Venus Labs. We are deployed around 6 chains now, closer to 8 by the end of the year, probably. We're a multi-billion-dollar protocol deployed 4 years ago, already in 2020.
Brilliant. So the first question I want to talk about is around yield, and specifically looking at a base rate for yield. So obviously, the base rate for yield in the past has been the ETH staking yield. And what I'd love to hear from the panel is, how do you all interpret the role of a base rate in DeFi, particularly in guiding yield expectations and in managing risk? Fig, do you want to start?
I'm a person that's triggered by the concept of base rate in crypto. First of all, because stablecoins are both fiat-backed stablecoins, floating currencies, and you could even argue that LSTs are stablecoins, right? The problem is the base rate is not ETH staking for a dollar stablecoin. If you're a dollar stablecoin, the base rate is going to be treasury bills. The same way that if you're a BTC user, the base rate is going to be nothing. So the whole problem is that we do not have a base rate for crypto. Could it be an average of the lending rate on all lending platforms? I think that's something interesting to look into. Is it ETH staking, as you're saying, because it's the base rate on the Ethereum ecosystem? I don't know. I feel there's eventually going to be a LIBOR moment in crypto. It just hasn't happened yet.
So my mental model for base rates in DeFi depends on like the coin. So for stablecoins, I see it as like the maximum between the real world asset like T-bills rate and the crypto leverage rate, whatever like the perp rate on Aave, Morpho, Venus. Usually, you know, when market is bullish, that rate is above the treasury bills rate, in which case like the DeFi base rate, you know, is that. And if this rate, you know, market is a little bit less bullish and, you know, rate goes down treasury bills, then can expect like, you know, real world asset leverage that takes the rate, you know, very close to T-bills rate. So that's for stablecoin, like USD stablecoins. For ETH, it's the same thing, but you replace T-bills by staking rate. And, you know, most of the time, you know, people are not short ETH, so the staking rate is always above like this ETH perp rate. And then for Bitcoin is like 0.01%, like just because very few people like arbit, short it. But still, there it's not zero, right? Like it's there's a little bit, especially with like those like restaking, like points narrative, and like as the utility of Bitcoin grows, there's just like a bit more demand for borrowing Bitcoin in general. But yeah, that's my quick mental model.
Yeah, I think I couldn't add more to that. I think I would agree with what you just said. I think the ETH base rates, the ETH staking rates, and the stablecoin rate depends on like the aggregate of all the different lending and borrowing markets. And Bitcoin yields, we will have to see where it comes from.
Yeah, in general, I think this concept of the base rate is interesting because in traditional finance, they have the T-bills. And a couple of guys on the panel already spoke to the idea of a token-centric rate, right? It depends on what token you're talking about. And if we take on a kind of view of like the next 5 years, is it just going to be about ETH or BTC? We're going to have a proliferation of assets. We're going to have a proliferation of base rates. And that just follows with the principles of DeFi, right? That it gives you more user choice, that there's going to be more fine-tuned risk profiles depending on which asset you're basing your strategy around. And so in the traditional finance system, one base rate, in DeFi, many base rates, and there will be a discontinuity, and that asymmetry will grow, right? Because we have more efficiencies in our system. We're going to be pulling away at warp speed. And if TradFi could deploy capital instantly into DeFi now, they would, but there's no technology or bridges to do it, right? There's frictions, there's on-ramping and all this. So there's going to be arb between the two. That's obviously a source of yield as well that we'll probably get into.
I think I realize we haven't really even defined what the base rate is, in the sense, well, basically it's just the rate that the main central emitter of an asset is ready to pay to people. So for the US dollar, it's T-bills, right?
Well, if you define it as like, the DeFi base rate, I would argue it's like the deposit rate you could get on your stablecoins for a very large amount. Meaning in DeFi below 1 billion, around. And if it's that, then it's probably the max of like leverage rate and T-bills. Then if it's above like 10 billions, then it's surely like, central bank's rate, obviously.
So, yeah, I see what you mean. I was really talking about the large scale. What I meant with this was that if you are a dollar stablecoin, and I know 90% of the issuers are here at this conference, you are basically subject to the dollar monetary policy from the central bank, so you are bound by their rates, right? What's interesting is that we're starting to build mechanisms that would enable us to basically unchain ourselves from this. And an example is the interest rates that are created on the Morpho protocol. With the, I think, I'm not sure exactly how Venus works, but I suppose it's the same. With basically the more demand you have compared to the actual outstanding supply of stablecoins you have, the more the interest rate go up, right? Another version that's going to release soon with Liquidity V2 is user-set interest rates. So what's happening is that current base rate in TradFi is set by the central bank. And the central bank is not perfect. It's actually people basically asking bankers, asking business owners how the market economy is doing, and setting it up manually. What we're seeing on Venus, Morpho, and then Liquidity in a different fashion is that we're doing market-driven mechanisms. So what's interesting for me is, are we actually switching the base rate for something that's set up by a central entity to not even a smart contract, but an actual common behavior from all of the actors in the ecosystem? And I think that's that's a question that until we have answers, we'll have a hard time in building very large and scalable advanced strategies for stablecoins over 10 billion.
I think quite a few different perspectives were shared there, but broadly, if we had to talk about it, we're looking at base rate that could be set by off-chain sources or centralized sources, which would be your T-bills rate. Whereas if you're looking more on-chain, this would be demand, for example, driven by lending markets. So maybe that's a framework we could start off with to proceed with further discussion. So the next question I want to touch on is more around stablecoin yield. And I'd love to get your thoughts on which markets, sectors, or strategies you believe have the highest yield potential for stablecoins? And would love to understand why you think these sectors or strategies provide more sustainable yield than others.
Yeah, it's probably context dependent, right? Like everything changed this week. So whatever expectation you have for the market for the past year, just kind of throw that away. But in general, we have some clues, right? So this kind of Athena model of bringing yield from off-chain and using the stablecoin, which is the killer app of yield distribution, to boost yields from things like a basis trade. That's an interesting hint about where things might be going. I think we'll see a expansion of this, and we'll see more Athena-like models, and it's super interesting because, anytime you have a revolutionary technology that's being adopted, it's not from 0 to 1 million, right? There's like incremental steps, and the Athena model is one such incremental step. It's a hybrid model, and there will be more of these. So that's an interesting and promising sector. And anywhere where there's more risk, I think we're now in a very much a risk-on environment. People want high yields, wherever those might come from. I don't know, municipal bonds, whatever it is, that will be a promising source for sure.
Yeah. Speaking of like the highest source of yield we have in crypto for stablecoins, my feeling is that it has to be, so it's not entirely in DeFi, but centralized exchanges like perps, just because like the demand for leverage over there is very retail oriented, and for better or for worse, they're paying huge fees, right? Like much higher than in DeFi. And so obviously the people arbing this, whether it's like through tokenized packages like, Athena or like directly on the centralized exchanges, like probably the highest source of yields that is, that can welcome decent size. Obviously, like you have all the farms and everything, but it's hard to have like scalable ones. So for me, this is probably the biggest, like most scalable source of yield, but it's getting arbed like every day a bit better. So yeah, that would be my take.
Yeah, I agree with that as well. You can arb that, but I hope we will live in a future where the price can be made on-chain. Of course, we all want that, because that will be actually better for our whole ecosystem to have on-chain price discovery and on-chain yields and make DeFi more efficient. And I do think like the highest yields are indeed like how Athena does it on centralized exchanges, but I also think in DeFi there's also a lot of inefficiencies, especially with all the abstraction that we're seeing. There's a lot of assets on certain layer 2s, or there's a lot of arbitrages in between on-chain that I think are a little bit underutilized still, and will also be net positive if we as an industry focus more on-chain price discovery and try to not get carried too much away with the, yeah.
And I would even add to that exchanges are all going on-chain, and over the next 6 months we'll see more and more perps or borrowing products coming directly from centralized exchanges, and that means that there will be no arb anymore, and they will tap into like on-chain pricing, on-chain liquidity that is supposedly more efficient, more active, etc. So I'm very excited for that, actually.
Yeah, the Kraken L2 and Binance with Binance Chain, I think it's all going to move on chain because they all want that. Everybody wants that. So I think it's going to move there. And the protocols that do the on-chain, like Morpho, Venus, like everybody this will be better for the industry, and it will be better for everybody, basically. DeFi will be easier to use, things will be cheaper, and we have higher yields as well.
Essentially, there are only, in my mind at least, 2 yield sources in crypto. It's lending and providing liquidity.
Market making, well.
For me it's the same. What I mean by this is everything else is structured on top of these 2 concepts. For example, funding rates from perps is a type of lending, right? So the question is, what is the most in demand and what scales the most? Because if you ask me today, and I'm speaking in a biased manner, there is more money to be made by providing liquidity, but it's also riskier. And the third thing is it scales less. There is a limited amount of liquidity that's needed in the ecosystem as a whole. Each time a new stablecoin project appears, this grows, and you should call us because we'll help you. But at some point, there's a limited amount of both liquidity available for this specific risk profile, and in general, liquidity that just in general. Lending is a bit different for two reasons. The first one is that lending is the basis of finance. It's the core concept that we build everything on top. And it's infinitely scalable as we create value because you can borrow against those assets that are tokenized today. So I think that the market for lending is much bigger, but I think there's more money to be made on providing liquidity today.
So we've had a few responses there touching on the importance of liquidity. And we've also touched on exchanges now moving on chain. And the next question I want to touch on is around fragmented liquidity. And I think we touched a bit around on-chain efficiency as well. And I want to dive into both of those topics a bit more. So the question is, do you see challenges with fragmented liquidity, with a lot of movement on-chain and with all the new L2s that are popping up around the place? And what innovations have you seen that help address some of these challenges? Amadeo, do you want to start off?
Yeah, I can start off and you can follow on. Like I'm very bullish on that because yes, it's now all fragmented and it's like we launched this L2 roadmap and we're still working on all these ZK provers or these glues and all these things that will glue it all together magically with coprocessors. I know it's not here yet, right? But if that comes, there will be huge yield opportunities because then we can start to build, credit default swaps. We can start to build, we can start to remove the different time duration risk between different products, and we will start to do proper risk trading between these financial instruments. And I'm looking forward to see that become more mature. Right now, it's still a lot of work to do there because it's super fragmented and there's a lot of base primitives that still need to be figured out. But I think when we get there, it's going to be this also the way the new YieldNest vaults are designed, the accounting all happens on layer 1, right? And some sort of a glue that will work with work with coprocessors, but that's of course something more futuristic. But it now optimistically works with different strategies that sync back to this L1 state, and then you can theoretically do a lot of arbitrage between all these different chains, different Morpho markets, different Venus markets. You can arb the funding and borrowing rates and make DeFi more efficient for the daily users, make it easier for people to swap and use different products, and at the same time earn a nice yield that we can feed back to the users of the protocols and the systems. Yeah.
Yeah, I would definitely second that. I'm super bullish reaggregation in general. I believe in a DeFi world where the protocols are completely ungoverned, completely immutable. And if you go in that direction, you have to have fragmentation, right? It can't be a whole monolithic pool like Ajey that is managed and controlled by a few individuals. There has to be few primitives. But then if you have, different immutable primitives, you have to choose. You put the complexity on the side of the user, and the user has to decide what's its own risk. And then it becomes all fragmented and all complex. And so that's why I'm so bullish on reaggregation. You have the same concepts with Uniswap. Uniswap v2 was pretty aggregated, very easy to interact with it on chain. Then Uniswap v3, you could trade on it on chain, but you could not LP on chain, very easily. You had to go through market makers or be quite advanced. And now Uniswap v4, you can't trade and passively and you can't LP passively. In both cases, you have to use reaggregations, right? Like Uniswap X reaggregates for traders, and the Arrakis of the world, they reaggregate for LPs, right? And I do think that's going to be the same thing for all DeFi in general, trustless, unopinionated, ungoverned, immutable base primitives that are super efficient, that everybody can rely on forever. And then on top of that, very complex and efficient reaggregation. We've built some of that with the Morpho vaults, but everybody is building, I'm super bullish of that. It's just going to happen over the next 6 months. And the level of efficiency increase that's going to happen in DeFi thanks to those reaggregation layers is going to be quite insane, right? And to me, this is how the main incumbents with all the aggregation through governance, at the core, will fall eventually.
I thought I was going to have a controversial opinion here, but it's the consensus. Yeah, all the tech that's arriving now, I think we saw coming and we anticipated over the past 2 years when there were these growing pains driven by liquidity fragmentation. But I think when people hear liquidity fragmentation, they should think liquidity innovation, right? That liquidity is going somewhere, it's trying something new, it creates this laboratory effect which underpins like all of the innovation that's going on in DeFi. So more, I think of it as liquidity innovation, liquidity expansion, and we were dealing with these growing pains more like a year or two ago when we didn't have the tech coming online that everyone here is now talking about, right? And of interesting projects like Cluster, Socket, Across, all this, and it's like going live now. So wherever the liquidity wants to go, it will get patched in, it'll create new opportunities, more yield opportunities. You know, we have, you know, people have described some of this liquidity fragmentation on Venus because we have isolated pools but with less liquidity, but in reality, you get other yield opportunities, exactly like you said. So more user choice, more innovation, better for everybody.
So I did not expect having the controversial opinion on this. I think fragmentation of liquidity is a meme. If you think about it, like 50 or 100 years ago, capital markets were separated by country, right? There was regulation, but there was also no way of actually moving capital around different markets outside of just taking a luggage with the cash in it and depositing it from one market to another. What happened is that we had internet, so now information became global, and information became less fragmented. It's now very unified in a way. Everyone accesses to the most of the information together, right? Capital is not the same yet. There's a lot of capital on the internet, but it's still fragmented between different countries with capital control. For example, you're never getting capital from China or India. It's just they can't take money out of the country. The interesting part about it is that if you frame crypto today this way, you realize it's a bit like nation states with geographical implementations, actually digital implementations, with specialized capital. So for example, you're going to have Base with the Coinbase capital, you're going to have Ethereum with Ethereum Maxi capital, Solana, etc., etc. And we're building bridges. What Uniswap is doing, for example, with the Cross is extremely interesting to bridge all of this together. But we're forgetting, and this is something I realized extremely recently, by the way, when you go and talk with this huge liquidity provider, because 90% of the liquidity is owned by 1% of the people, they're not all profit maxi. They want a certain thing with the base rate or just above, but they want aligned capital and aligned primitive. So when you're going to want to create your own protocol as a stablecoin provider, you're going to think, I'm going to create the best yield, and this is how I'm going to attract so many more people towards my project. You do this, you have the best yield for maybe 3 months, and then you get outshined because context changed, right? And you don't understand why you didn't get capital in the meantime, even despite your airdrop. That's because you built a solution that only you care about, or profit maxis care about. But when you're going to see the big treasuries, they want something aligned with their ecosystem. Maybe they're an L2, maybe they're an L1, maybe they're a centralized exchange, maybe they're a state fund. All of these guys have an actual agenda, and you need to align capital with them. So if you look at it this way, liquidity is fragmented for ideological, political, economical reasons, and you have to take these into account to actually build your advanced strategies.
Yeah, I think that's a very fair point.
Brilliant.
The United States of Ethereum, right?
That's why we should not build dollar stablecoins, to be honest. Everyone is building this because it's the most scalable, and there is no real direct economical incentive in building something that is not dollar-backed, because that's the prime utility. But the truth is we will never have a DeFi native base rate on something not as volatile as if we don't actually build floating currencies. And that's the whole... You're right, the United Nations, the United Protocols of Ethereum is the ideal. We should create it.
There we go, United States of Ethereum. So when we're looking at yield, there's usually a relationship between the risk associated with getting that yield and the size of the yield itself. And so as DeFi grows and matures, we need to be more cognizant of the different risk profiles that users of DeFi would be after. So for example, there'll be certain users who prefer more the conservative approach, those who prefer the more balanced, and those who prefer the high risk, high yielding opportunities. I'd love to hear from the panelists how you see protocols approaching this. Maybe, Paul, you can start off?
Yeah, of course. So, obviously before building Morpho as we are right now, we had another protocol that was called Morpho Optimizer. It was actually built on top of Ajey and optimizing the rates of Ajey We actually had $2 billion deposited on Ajey. We're the biggest user by quite far, both on the borrowing and on the lending side. And one of the biggest limits we had at the time is that we could only offer one risk-reward profile to users. And when I say risk, I include everything like compliance, like restrictions, etc. Like there's only one profile. It's a one-size-fits-all model for everybody, right? So that did not look very scalable to us. Like if you think of DeFi not as supporting banking for crypto users and the gens, but you think of DeFi as true financial infrastructure for all the banks or everybody in the world to build on like decentralized rails. Well, of course, you have to build infrastructure that supports different risk profiles, different compliance profiles as well. And so that's why we decided, even though we were growing with this optimizer protocol, to sunset it and to build something completely different that allowed for the expressivity of those like different risk profiles, right? And so the big questions when you start expressing different risk profiles is like, okay, the things we were just discussing before is fragmentation. Like every new risk profile, new fragmentation. So you have to build solutions that factor in this liquidity fragmentation, whether it is through reaggregation or just by limiting the dimensions. Like yes, we need risk diversification, different risk profiles, but you don't need an infinite number of risk profiles. That would be like unuseful, fragmentation. The same way Uniswap v3 does not allow you to set like any fee tier. You can just use 4, right? Now they have Uniswap X, so the reaggregation is perfect, so they can allow for a lot more. But anyway, that's another topic. So yeah, definitely needed as we scale. And I can't imagine that some protocols actually think until not so long ago were thinking it was going to be a one-size-fits-all. Now people like Morpho came, so the Aves of the world are trying to create new pools and have like bespoke like risk profiles, but it clearly wasn't made for that in the first place. But yeah, definitely needed.
I was very surprised. I started in corporate law before going into DeFi about the risk profile of most people. So as Paul mentions, there's not that many different risk profiles. No, it's actually, if you look at, I expected yield trading, something on Pendle or idle finance, where junior and senior tranches, to exist in crypto. The principle for those who don't know of tranching is basically you're separating yield and risk from a senior tranche that's going to take a lesser part of the risk for less yield, and a junior tranche with more yield and more risk. In TradFi, funds love the senior tranche because it's good yield, very safe. In crypto, everyone goes into the junior tranche and there's no capital into the yield senior tranche, which makes no sense in traditional terms because everyone that's actually core users is going to go fully risk on. So sometimes they don't even realize the core risk that they're taking in providing liquidity, for example. And the people who are not taking risk, if you're thinking I'm unique, it's either because you're a treasury manager or a risk manager. It's the only two categories of people who are not taking the risk on approach in crypto, or you come from TradFi. So in a sense, risk management in DeFi is not that, I don't want to say important, but omnipresent, because most people haven't developed the acumen to actually think of it this way. They look at the yield, but they don't take into consideration all of the risk.
I mean, for now, right?
Yeah, I think it's the fault of the industry, right? Because like if you look at the interfaces, like how they build, it's like everybody's pushed into the junior tranche. Like it's like everybody's like guided into the.
No, for example, on idle finance, it was like purely really neutral, and they had this whole problem.
You see 10% risk or 20% risk. And 20% is made it just a little bit bigger.
But
and
people
then
don't see the risk. That's the thing. The risk is not quantifiable. You have to do the research and do it yourself.
I know, but like, I think people the literacy and the information and all that is not given, and a lot of time that's done on purpose. And yeah, it's very bad. But I think that's something we need to change, right? We need to be very clear about like, yeah, this is a junior senior tranche. And I think we're going to go in that direction with more information, and we don't need regulations and all that stuff, but we will need to educate people more on that.
In a sense, it's self-regulation. I totally agree with you. What I'm saying is that most of the people will never spend the required amount of time to do the due diligence. I mean, look, for example, on Venus or on Morpho, you have risk managers, professional people who do it. Why is the core team not doing it and integrating? For decentralized reason, but also because they don't have the expertise or the time to do this. There's a lot of everything. And the real truth is that unless you're a huge whale, you're not going to have any incentive to actually spend the time on doing this. So when you start doing it personally, you've probably made it.
Yeah, I think there's like a lot of relevant topics here in terms of risk profiling and regarding tranching. And there's a lot of opportunity that is yet to be deployed around tranching at the multi-billion-dollar level. And that's just a little tease of what Venus is coming up with next. So stay tuned.
Amazing, amazing. I also think it's not like maybe it's a little bit off track, but it's not like transactions per second. It's more like time to finality, right? And I think it's like if you can trade those risks of the time to finality, I think that all these things will need to be a bit more abstracted away, but we can do a lot of really cool financial products there where there is some risk, but if we communicate it very clearly to the users, like this is the risky one, this is the less risky one, I think that's a good way to move into.
It is important because there is no yield if there's no risk. You're being paid because you're taking.
We see that now on Eigenlayer, all the risk taking.
Yeah, on that we've gone quite deep onto like how do we improve user experience. Like on Morpho, you have like thousands of markets, you know, and vaults are like those kind of like abstractions where risk managers are aggregating those complex markets for users. But even with that, we have like 20, 30 different vaults, and people easily get lost. So we've been thinking a lot about how do we aggregate that information of risk in an easy and simple way. And don't want to spoil too much what's on the roadmap here, but I believe we found a decent solution to show in a quite decentralized way what is roughly the risk of like each of these vaults, and I'm quite bullish to release that in like the next few weeks.
Excellent. A few exciting developments coming up in the near future. I think one more question I want to ask is on risk itself, but more around the role of DAOs in risk management. Are there any practices or structures that you think actually help DAOs be more effective at risk management, or do you actually just see them as being more limiting and basically not suited to managing risk? Thoughts on that?
Yeah, DAOs are not a perfect beast, right? And this kind of plays into the theme of how much things will be different from how they have been. So past is not prologue for the next few years of DAO governance. I think it's going to look really different. I think we're going to have specialization even within risk management, right? So what you have now on the biggest protocols is a single risk manager, maybe two, that's kind of dominating the whole field of risk that needs to be looked after in the protocol. I think that's going to change. I think you'll have more diversity, more specialization, because in effect that one risk manager can be considered a point of centralization. At the same time, these risk managers are innovating, and there's some really interesting announcements that are coming up this week with risk managers regarding making it more streamlined and helping us to be more adaptive to the speed of the market. So we're going to go at we're now going at warp speed in DeFi. We want to be at warp speed, and the risk managers and the DAOs have to follow. That's the challenge to meet, and I think we'll get there.
I think all of us who have a live token or a live DAO have learned the hard way that I hope I'm not going to take too much shit for this. Don't listen to your community or your DAO. Like most of the stakeholders are simply not risk managers, and I am not either, to be honest. So the logic idea of hiring a specialist seems like the right one. The question is, how do you incentivize him properly? You just pay him a service fee like Ajey is doing, for example? I think for me there was a watershed moment in a sense, which is when Morpho introduced Morpho Blue. Because the curator model creates an alignment where risk managers can actually profit from doing their own analysis and people trusting them. The problem, and I think we're yet to see this, is what scale you need to reach for this to be profitable. And I think it's a very big scale.
I'm not too sure. I think most of the risk managers on Morpho right now are profitable, or if they're not, it's just because they have set their fees to zero. So I guess my take on risk management is that fundamentally, risk mitigation is about trying to predict the future or like anticipating what's going to happen on the market. And that's very, different from decentralization and, what we use decentralization for in general. So there's obviously a tension between like a DAO is like super slow, super decentralized, and frankly not so smart, just because there's no reason for which like a token holder should be like, as you said, a risk expert or should have like the right incentives to do risk management. The honest answer is that I don't know what's the best way to risk manage like lending pools, and this is why we've modularized it in Morpho. Like you could have on Morpho we have Maker, they're doing the service model where the vault is owned by the Maker DAO. And I believe there's having services from Block Analytica to do the risk management. Or we have other vaults like the Gauntlet vault. Gauntlet used to do risk management as a service for Ajey. Obviously, had a lot of like politics involved because you have to be whenever the delegates tell you something, you have in some way there is a obvious misalignment problem with this. I'm not saying it's bad. I'm just saying like it's not perfect, right? And so they moved to this curator model where they're like running their own vaults. Today I believe they have like 150 or 200 million deposited in their vault, and they have no there is no politics involved. Like they don't get to like me or to talk to me when they run their vaults on Morpho. I don't have any control over their vault. They own it. They own their fees. They own their risk management. Which, in my opinion, has proven to be an exceptional model. We're extremely aligned with our vault managers and very happy to collaborate with them. And even if we were not, like, we don't have control over what they're doing. So, yeah, pretty bullish, like open modularization of risk managers, and a slight preference for like the curation model, where risk managers, put their brand name and also earn their own fees based on the volume that they create.
Yeah, I think that's amazing. Like modularization of risk managers is a really good innovation. Like, I think Morpho kind of started with that, with like specialized vaults, with separate risk managers, and I think DAOs need to have specialized, not internal in the DAO, like external, unopinionated data feeds of reports that explain what's actually happening. I'm a big believer in the 100 monkey effect, so that means that even if a small group of people read those reports, it will have a high impact, and for the DAOs and for everything around that decentralized organization.
Yeah, I think I misexplained my point. What I was trying to say is that it works with Morpho. It likely will not work with most projects because they will simply not have enough assets under management for this to be profitable for users.
If you make one sub-DAO, you have one unit, for example, you can start like that. And then
yeah, I agree with you, but I'm seeing tens and tens of projects copying that model, and I understand why.
No,
I'm just worried that they will never reach the sustainable point for this to work.
Right, I agree. Like if you're going the curating path, you have, in my opinion, for risky products, you have to have 20 million AUM to hope to be profitable. Low risk products, at least 100 million. That's a rough like approximation. Then if you're a curator, you could also go to like new projects, trying this model and farm their grants, and then maybe you'll be profitable thanks to that. But other than that, you have to target those numbers.
Grants have too much politics. It needs to be this stream of money that they can do what they want. Else it's just.
Cool. So we have just under a minute left. I think what would be good is if each of the panelists could just give a way that folks in the audience can follow you for updates, any new developments that you want to be sharing. What would be the best way for them to stay updated?
I'm constantly shill posting on Twitter, as I imagine everybody in this room is right now. And we're going to soon announce the next version of Venus, which has been underway for the past 2 years in waiting. So we're ready to pop this out of the oven and excited to announce it.
Amazing. Yeah, you can find me also shit posting on Twitter. Find YieldNest.finance. We are just yesterday evening released a new YieldNest Max ETH vaults. Is a new kind of vault architecture that I'm going to experiment with, and it's a 1 million cap. We're going to experiment with a kind of new like architecture about trying to build the glue around all these different yield opportunities to make DeFi more efficient for everyone and have a high yield on top of that as well. Yeah.
What's your Twitter handle? I forgot to say mine. It's Brad here now, by the way.
Yeah, my handle is Amadeo at Amadeo Brands. My full name, very simple.
So on our end, it's morpho.org.
I'm gonna be a bit more ambitious than you. If you want to follow a Frenchman complaining about DeFi, Fig_me. Spicy on the agenda. No, if you want to follow a new primitive we're about to build, follow Mithras, Mithras Labs. It's our company Twitter, it's Stealth, and otherwise it's Paladin.vote.
Awesome. Thanks. Could we get a round of applause for the panelists?
So a quick selfie.